What's up, traders? Are you ready for the biggest event of this year, so far at least? Never have been such as uncertainty. What the fuck? I'm start talking like Lagarde. Regarding the next move of the Fed, 25 or 50. For me, it's at 25, but I don't know how the last 2 weeks the expectations changed so much. What games they are playing behind our backs. Okay, let's see. Less than 22 minutes to go, and we will find out. In the meantime, let's check. Okay, here we have the chart, Euro USD. Flat line. Since this week, exactly we are in the middle of the range of this week. Expected, because when we have FOMC and especially such a serious event, nobody wants to take. At least market doesn't move very big in one direction. Okay, we have had this 25-30 pips whipsaw up and down, but so far we still hold 111 and 111.50. 50 pips range is nothing for 3 days. Today we are gonna break it. To be honest, I expect something like that. Okay. Let us check the... Okay, let's start with crypto. Yes, crypto usually like the cuts, the rate cuts, because it's $1 friendly. Let's move to the 4-hour chart better. Okay, we see that Bitcoin for the last few months, it is just trading in this almost parallel channel, making something like a flag, but it's taking too much. Currently we are exactly in the middle of the range, 50,000, 70,000, above 20,000 range. We are sitting exactly at 60 and waiting. I believe that we are not gonna see any big divergences outside of this range for the next weeks, but who knows. If we see something unexpected like a 50 rate cut from the Fed, what will happen? Someone says that the half saying that this will scare the market, so even the crypto will go down. The other says, okay, this is good, this is gonna boost the market, so we are gonna see big breakout to 75, 80. Who knows? Okay, Ethereum even worse, break down to the downside. You know that I'm bearish Ethereum because it's useless. Sol is taking over. Sol is holding this range of $120-190. We have played this range many times if you are following us this year in Twitter. And of course in my private Discord club. Here we are sitting in the lower side of this range, $128. What to say here as well, if we see some risk on, we are gonna see quickly $180-190. Okay. Now regarding indices. We trade the Nasdaq and the S&P. Okay, this let me go to the normal indices, not the futures, the spot. We see that S&P is trying to make a double top here. We have actually a triple top, 1, 2, 3. The odds are, okay, there are two camps, of course, the perma bulls that seeing 6,000, 7,000 break to the upside, and perma bears that see 2,000, 3,000. Okay, if we take out this of the question, what we see here, we see a correction. Okay, maybe we have had it went too deep, but we see 3 waves, A, B, and I expect another 5 wave down to C. Maybe to test the levels 5,000, 5,050. Max at 49 something, but I don't see the steep decline that the perma bears are dreaming all the time. Like it or not, stocks are gonna have support no matter what, especially when the Fed starts the cutting cycle as it seems today. Okay, now we're gonna have those disconnects from the brokers. I have many platforms open, you have to bear with that. So, okay, I don't have a position here. I would like to sell any rip to the upside just for speculation. But I believe the next days, no matter what, we're gonna see higher, drifting higher. Of course, a better scenario for me would be to have a downward move lower to test the 520, 5020, 200, 5050, this area down here. Also, we see the moving averages are pointing higher. This pillar of support, as I like to say. Of course, we have had here one bridge. Here the second was deeper. Now the third was lower, shallow. This moving averages is providing support and giving us the direction. We are gonna need a lot of effort to turn this trend to the downside. We must see a break below 5,090. Not seen for now. Okay, let's see Nasdaq. A little bit more bearish case here. In Nasdaq we have traded the top with a lot of success last month, July. Okay, now we are just consolidating inside. We see here still the moving average pillar providing support. I would be very surprised to see any move below 17,000 the next days. Here I see something like the S&P, maybe a bit higher to spike to test 20,000. I mean 19,800, 20,000. And of course big support at the recent low. Also the moving average of 200 periods days is coming here at 18,220. So I don't expect any big surprises here. Buy the dip is the name of the game again in stocks. Okay, in Nasdaq. Okay, what else you want to see? I know you wanna see the dollar. The dollar is sitting just above a heavy support, a strong support at 150-60 area. And I will be honest, we see the dollar from the beginning of the summer has been trading lower in a very steep downward path, and is gonna need a lot of work to resume the uptrend, because also the moving averages have crossed and pointing lower. But of course I would like to see one touch of this MA, never touched before after the reversal here. So I wouldn't be surprised to see 102.80s, 103, especially if Fed is not so dovish as everybody believes. And we see the 25 and we see. Actually, let's see what can we expect, at least from my perspective. I don't believe Fed is gonna give clear forward guidance. I believe they are gonna do 25 and say where will remain data dependent. Of course, they are gonna play out the 50 basis point, especially in the questions. They are gonna ask for it. Powell is gonna have a very tough job. And of course, some members maybe they are gonna say for sure that 50 basis point cut was discussed. Mark my words, and this is gonna create one dovish move in the markets, in the dollar, and I'm expecting this, to be honest, in order to load up the dollar crosses. I expect this move. Okay. To test for another time the 150-60 area, and then I believe we are gonna see steep reversal higher the next days. This translates in the euro. Okay, of course the 112, 115, 111, 50, 60 area, we are almost there. And maybe we see 111.80, 112 max. I don't believe we are gonna see new highs easily, especially with Davis CCB. Now, cable, one of the same. We caught nicely this reversal, this fake break in our Discord. We short exactly the top 48.50 area. So we milked all this move down almost 50 pips. But the important here that is still we are in an uptrend. Of course, the cable has to bear with Bank of England tomorrow, when everybody expects a zero. We have moving gold, and I have some positions open, so let me cover some.
Order filled.
Okay. Oh, nice moving gold. Very nice.
Order filled.
Sorry guys, but I'm trading live. Okay, I covered the positions in gold. But I have also in another account. What I was saying, I was talking about the dollar, the cable that we have a Bank of England tomorrow. What to say here, I would like to fade any possible move towards 32, 60, 70, 10-20 pips higher than this high, in case we see any dovish comments. But I believe we are gonna see 131, 50, 60 tomorrow easily, or today of course if we see the 25. But this level is gonna provide support for the cable, especially ahead of Bank of England tomorrow. I don't have any position now. I'm okay, slightly short in the spot, but I wanna cover in this area if we see 131, 50, 60. Okay. Less than 8 minutes. I know you all love gold. As I said this morning, I see this downward channel that is forming. I wouldn't be surprised to see another test of 2560 and even lower to test 2550 45. Also there is big horizontal support here. Of course I'm ready to buy this dip. This would be the ideal double confluence of supports 2544. I don't know if we go down there today, but why not? Okay, let's see. Less than 6 minutes. Oil, my friends, you want oil? Let's see, oil. Oil after this drop found support, tested actually the 67. I pointed 67, 14 for the reversal. Here we are. Of course, a lot of job has to be done. We must return inside this channel, this triangle that we broke. I still believe that the next couple of months we are gonna see a move towards $100. I don't know what will be the trigger, but it is what I see. Anything else? Less than 5 minutes to go. Okay, let's put the 5 minutes more. No, put 30 minutes. We are gonna have a spike for sure. Okay, what you want? Euro, cable, or gold? I believe gold, so I'm gonna leave it to gold. I just finished my coffee. Let's see if we are gonna bring the whiskeys and the cohibas. Paul is ready. Okay, another small cigarillo for now. Dun, 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 dun. Okay, are you ready? 2 minutes. Let's see. Less than 30 seconds. Last bets. Okay, here we go, guys. Give us the 25. Whoa, 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 whoa. Why? Why? What happened? 50. Fuck. 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 Fuck the Powell. 50. What the fuck they are doing, really, guys? Oh boy. Okay, nice that we didn't have any position. But we are gonna do now. What the fuck, really? What the fuck? What the fuck? Okay, I don't touch anything for now. Let the market relax. Yes, only JP Morgan took it. What I said, crypto is finding some love. Stocks too. But I believe we are gonna see a reversal soon. Dollar giving us the leg lower. And here we go. Here we see the reversal now. What to trade now? Let's short some euro dollar. Small positions. How the fuck the markets now? Okay, remains to hear with a lot of anxiety the Powell. Not now. Because maybe they say that we do 50 and we wait, something like that. Okay, I have to answer to this. let the market breathe. So far it is what we said, the levels, 80 for the pound, 60 for the euro. GBP, the yen didn't blink. What? We see the dollar finding support. I think my scenario of this, is taking places. Of course, we must return above 50 to be sure. Stocks reversing, exactly what we said. Gold didn't make new high, very strange, at least for now. I was expecting gold to thrive higher on 50. Okay, we have a lot of time, of course. I don't touch anything. Let the price action speak. For now, shows dollar weakness. Maybe shorting stocks is better. Powell will have a lot of job to explain us why he did the 50 now. Okay, I'm gonna mute the sound and come back. Okay, let's wait for JP now. I will come back in 20 minutes. Okay,
In the labor market, conditions have continued to cool.
we start with
Job
JP.
gains averaged 116,000
Cigar
per month
ready.
over the past 3 months. A notable step down
Room
from the
ready.
pace seen earlier in the year. The unemployment rate has moved up, but remains low at 4.2%. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggest that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of elevated inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year, 0.4 higher than projected in June. Inflation has eased notably over the past 2 years, but remains above
260
our longer-run goal of 2%.
in gold.
Estimates based on the Consumer Price Index.
I would
and
like
other
to
data
try
indicate
some
that
shorts
total
here.
PCE prices rose 2.2% over the 12 months ending in August, and that excluding the volatile food and energy categories, core PCE prices rose 2.7%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.3% this year and 2.1% next year, somewhat lower than projected in June.
Yes,
Thereafter,
260
the median
in
projection is 2%.
gold.
Our monetary policy actions are guided by our dual mandate to promote maximum employment and
Let's
stable
hear the
prices
old
for
man.
the American people. For much of the past 3 years, inflation ran well above our 2% goal, and labor market conditions were extremely tight. Our primary focus had been on bringing down inflation, and appropriately so. We are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our restrictive monetary policy has helped restore the balance between aggregate supply and demand, easing inflationary pressures and ensuring that inflation expectations remain well anchored. Our patient approach over the past year has paid dividends. Inflation is now much closer to our objective, and we have gained greater confidence that inflation is moving sustainably toward 2%. As inflation has declined and the labor market has cooled, the upside risks to inflation have diminished and the downside risks to employment have increased. We now see the risks to achieving our employment and inflation goals as roughly in balance, and we are attentive to the risks to both sides of our dual mandate. In light of the progress on inflation and the balance of risks, at today's meeting, the committee decided to lower the target range for the federal funds rate by a 0.5 percentage point.
We don't have a new high in the euro.
0.25% to 5%. This recalibration of our policy stance will help maintain the strength
First
of the
setup
economy
would
and the labor
be
market,
to short the
and will continue to
cable
enable further
at
progress on
65.
inflation as we begin the process of moving toward a more neutral stance. We are not on any preset course. We will continue to make our decisions meeting by meeting.
And here we go.
We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing restraint too slowly
Let's
could
start
unduly
sorting
weaken
slowly,
economic
slowly.
activity and employment. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant
We see
projects
that bonds
the appropriate
already
level of the federal
reversing,
funds rate will be
didn't move,
4.4% at the end of this year and 3.4%
didn't even make
at the
new
end
high.
of 2025.
This is a sign that we are gonna see big
These
reversal.
median projections are lower than in June, consistent with the projections for lower
Already
inflation and higher
started.
unemployment, as well as the changed balance of risks.
Gold.
These projections, however,
Here we
are
go.
not a committee plan or decision.
Let's short
As
this
the
shit.
economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both
Yes,
sides.
blah, 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 blah.
The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation back down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Steve Leisman, CNBC. Thank you, Mr. Chairman, for taking our questions. In July, you said you weren't necessarily thinking about a 50. You didn't want to be specific, but you said you weren't thinking about a 50. The inflation data last week came out a little firmer than expected. Retail was strong, third quarter GDP running 3%.
Exactly. Why the fuck he cut?
It made the committee go 50. And how do you respond to the concerns that perhaps it shows the Fed is more concerned about the labor market? And I guess should we expect more 50s in the months ahead? And based on what should we make that call? Thank you.
So, okay, a lot of questions in there. Let me jump in. Since the last meeting, we have had a lot of data come in. We've had the two employment reports, July and August. We've also had two inflation reports, including one that came in during blackout. We had the QCEW report, which suggests that suggests that the payroll report numbers that we're getting may be artificially high and will be revised down. You know that. We've also seen anecdotal data like the beige bar. So we took all of those and we went into blackout and we thought about what to do, and we concluded that this was the right thing for the economy, for the people that we serve, and that's how we made our decision. So that's one question. What was the second and third?
How do we make this? Sorry, thank you, sir. How do we figure out in the months ahead? Is there another 25 or 50 coming in? Based on what shall we make that call? Thank you.
Sure. So, a couple things. A good place to start is the SEP. But let me start with what I said, which was that we're going to be making decisions meeting by meeting.
Meeting by meeting,
data, the evolving outlook,
meaning that 50 and pause.
If you look at the SEP, you'll see that it's a process of recalibrating our policy stance away from where we had it a year ago when inflation was high and unemployment low, to a place that's more appropriate given where we are now and where we expect
more
to be.
shorts,
and that process will take place over time.
Dollar will thrive, don't worry, guys.
The SEP that suggests the committee is in a rush to get this done. This process evolves over time. Of course, that's a projection. That's a baseline projection. We know, as I mentioned in my remarks, that the actual things that we do will depend on the way the economy evolves. We can go quicker if that's appropriate. We can go slower if that's appropriate. We can pause if that's appropriate. But that's what we're contemplating. I would point you to the SEP as just an assessment of where what the committee is thinking today. But the individual members, rather, of the committee are thinking today, assuming that their particular forecasts are realized.
Gold already giving back.
Hi, Chris Rugaber at Associated Press. Thank you. The projections show that the Fed officials expect the Fed funds rate to still be above their estimate of long-run neutral by the end of next year. So does that suggest you see rates as restrictive for that entire period? Does that threaten the weakening of the job market that you said you'd like to avoid? Or does it suggest that maybe...
No forward guidance from Powell. This is...
Thank you.
I think the way I would really characterize
this means that they don't know what to do. That's why they did the 50, so now they are waiting for fresh data.
They would say there's a wide range where that could fall. So
the pressures to Powell for the 50 were big enough.
Empirically based approaches that estimate what the neutral rate will be at any given time. But realistically, we know it by its works. So that leaves us in a place where we'll be
$15 lower from the highs.
To be continuing to remove restriction, and we'll be looking at the way the economy reacts to that, and that'll be guiding us in thinking about the question that we're asking at every meeting, which is our policy stance the appropriate one? We know if you go back, we know that the policy stance we adopted in July of 2023 came at a time when unemployment was 3.5% and inflation was 4.2%. Today, unemployment is up to 4.2% and inflation is down to a few tenths above 2. So we know that it is time to recalibrate our policy to something that is more appropriate given the progress on inflation and
let's see now.
Employment moving to a more sustainable level. So the balance of risks are now even, and this is the beginning of that process.
Give us the big reversal now,
which is toward a sense of neutral, and we'll move as
dollar
fast
is
or
dead,
as
right?
slow as we think is appropriate in
Let's see
real
what
time.
happens
you
when
have
we
is
cross
our individual accumulation of individual estimates of what that
55.
would be in the base case.
Howard?
Howard Schneider with Reuters. How close was this in terms of decision? You do have the first dissent by a governor since 2005, I think. Was the weight clearly in favor of a 50, or was this a very close decision?
I think we had a good discussion. If you go back, I talked about this at Jackson Hole, but I didn't address the question of the size of the cut, left it open, and I think we left it open going into blackout. And so there was a lot of discussion back and forth, good diversity of opinion, excellent discussion today. I think there was also broad support for the decision that the committee voted on. So all 19 of the participants wrote down multiple cuts this year, all 19.
Okay.
That's a big change from June, right? 7 of them wrote down 3 or more, and 17 of the 19 wrote down 3 or more cuts, and 10 of the 19 wrote
Stocks
down
are
4
reversing
more
as
cuts.
well.
So,
Exactly what we
there's
described.
and there's a range of
If you
views, but
didn't
there's
see the
actually
first
a lot coming
20
down
minutes
the
of this live, guys, we described the situation exactly.
Now that this is in the books, can you give us some guidance as sort of follow up to Steve on the pacing here? Would you expect this to be running?
Give me
every
now
other meeting,
25.50
once
for
we get
gold.
into next year?
Yeah, we're gonna take it meeting by meeting. As I mentioned, there's
Meeting
no
by
sense
meeting.
that
Exactly what I
the
said,
feels
okay.
It's in a rush to do this. We made a good.
Thank you,
strong
Powell,
start
for
to this,
giving us
and
better
that's
levels to buy the dollar.
frankly a sign of our confidence. Confidence that inflation is coming down toward 2% on a sustainable basis. That gives us the ability. We can, make a good, strong start, but. And I'm very pleased that we did. To me, the logic of this, both from an economic standpoint and also
Buying
from a risk
USD
management
CAD as
standpoint,
well.
was clear. But I think we're going to go carefully, meeting by meeting, and
Meeting
make
by
our
meeting,
decisions
okay.
as we go.
Bye-bye yields.
Hi, Chair Powell. Gina Smilek with the New York Times. Thanks for taking our questions. You and your colleagues in your economic projections today see the unemployment rate climbing to 4.4% and staying there. Obviously, historically, when the unemployment rate climbs that much over a relatively short period of time, it doesn't typically just stop. It continues increasing. And so I wonder if you can walk us through why you see the labor market stabilizing, sort of what's the mechanism there, and what do you see as the risks?
So, again, the labor market is actually in solid condition, and our intention with our policy move today is to keep it there. You can say that about the whole economy. The U.S. economy is in good shape. It's growing at a solid pace. Inflation is coming down. The labor market is in a strong pace. We want to keep it there. That's what we're doing.
Sorry, Nick.
Okay, let's hear Timiraos.
Chair Powell, does
This
today's
fucking
action
guy.
constitute a catch-up in action given recent substantial revisions to the employment data? Or is this larger than typical rate cut a function of the elevated
yes.
nominal level of the policy rate such that an accelerated cadence could be expected to continue?
Okay. Multiple questions in there. So I would say we don't think we're behind. We do not think we think this is timely, but I think you can take this as a sign of our commitment not to get behind. So it's a strong move. So your other question was?
Well, is this about what happened in the employment data between this meeting and the last meeting, or is this about the level of the funds rate, the high nominal level of the funds rate relative to what might be expected if you're trying to maintain equilibrium?
So I think it's about, we come into this with a policy position that was put in place, as you know, I mentioned in July of 2023, which was a time of high inflation.
Of course, every
very low
click is
unemployment.
profit taking.
We've been very patient
MetaTrader.
about reducing the policy rate. We've waited. Other central banks around the world have cut many of them several times. We've waited, and I think that patience has really paid dividends in the form of our confidence that inflation is moving sustainably under 2%. So I think that is what enables us to take this strong move today. I do not think that anyone should look at this and say, oh, this is the new pace. You have to think about it in terms of the base case. Of course, what happens will happen. So in the base case, what you see is, look at the SEP. You see cuts moving along. The sense of this is we're recalibrating policy down over time to a more neutral level, and we're moving at the pace that we think is appropriate given developments in the economy in the base case. The economy can develop in a way that would cause us to go faster or slower, but that's what the base case says.
And if I could follow up on the balance sheet. In 2019, when you did the mid-cycle adjustment, you ceased the balance sheet runoff. With a larger cut today, should there be any signal inferred about how the committee would approach end state on the balance sheet policy?
So, in the current situation,
so far we have
stable. They haven't come down, so reserves are still abundant.
A hawkish cut.
So for some time, as you know, the shrinkage in our balance sheet has really come out of the overnight RRP. So I think what that tells you is we're not thinking about stopping runoff because of this at all. We know that these two things can happen side by side. In a sense, they're both a form of normalization. And so for a time, you can have the balance sheet shrinking, but also be cutting rates.
Colby. Thank you, Colby Smith with the Financial Times. Just following up on Gina's question on rising unemployment, is it your view that this is just a function of a normalizing labor market amid improved supply, or is there anything to suggest that something more concerning perhaps is taking place here, given that other metrics of labor demand have softened too? And I guess in direct follow-up to Gina is, why should we not expect a further deterioration in labor market conditions if policy is still restrictive?
So I think what we're seeing is clearly labor market conditions have cooled off by any measure, as I talked about in Jackson Hole. And but they're still at a level. The level of those conditions is actually pretty close to what I would call maximum employment. So you're close to mandate, maybe at mandate on that. So what's driving it? Clearly, payroll job creation has moved down over the last few months, and this bears watching. By many other measures, the labor market has returned to or below 2019 levels, which was a very good, strong labor market, but this is more sort of 2018-17. So the labor market bears close watching, and we'll be giving it that. But ultimately, we believe, with an appropriate recalibration of our policy, that we can continue to see the economy growing, and that will support the labor market. In the meantime, if you look at the growth in economic activity data, the retail sales data that we just got, second quarter GDP, all of this indicates an economy that is still growing at a solid pace. So that should also support the labor market over time. So, but again, it bears watching, and we're watching.
And just on the point about starting to see rising layoffs, if that were to happen, wouldn't the committee already be too late in terms of avoiding a recession?
That's our plan, of course, has been to begin to recalibrate. And as you know, we're not seeing rising claims. We're not seeing rising layoffs. We're not seeing that, and we're not hearing that from companies that that's something that's getting ready to happen. So we're not waiting for that, because there is thinking that the time to support the labor market is when it's strong, and not when you begin to see the layoffs. There's some lore on that. So that's the situation we're in. We have, in fact, begun the cutting cycle now, and we'll be watching, and that'll be one of the factors that we consider. Of course, we're going to look at the totality of the data as we make these decisions meeting by meeting.
Michael McKee with Bloomberg TV and Radio. To follow up on that, what would constitute for you and the committee a deterioration in the labor market? You're pricing in basically by the end of next year 200 basis points of cuts just to maintain a higher unemployment rate. Would you be moving to a more preemptive monetary policy style rather than, as you did with inflation, waiting until the data gave you a signal?
No, we're going to be watching all of the data, right? So if as I mentioned in my
Okay,
remarks,
now
if
we
the
don't
labor
wanna
market
see
were to slow
lower low
unexpectedly,
in the dollar.
then we have the ability to react to that by
And
cutting faster. We're also
and
gonna be looking at
101
our mandate, though. We
will
are
come very fast.
we have greater confidence now that inflation
next
is moving down
minutes.
to 2%, but at the same time, our plan is that we will be at 2%.
Same in gold. We just
over
want to see
time,
the
over
reaction
time.
failing
And policy,
going
we
back
think, is still restricted,
lower.
so that should still be happening.
I'm just curious as to how sensitive you'll be to the labor market since you forecast we are going to see higher unemployment and it is going to take a significant amount of monetary easing to just maintain it.
So, what I would say is we don't think we need to see further loosening in labor market conditions to get inflation down to 2%. But we have a dual mandate, and I think you can take this whole action as take a step back. What have we been trying to achieve? We're trying to achieve a situation where we restore price stability without the kind of painful increase in unemployment that has come sometimes with disinflation. That's what we're trying to do. And I think you can take today's action as a sign of our strong commitment to achieve that goal.
Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. You're describing this view that you don't think you're behind when it comes to the job market. Can you walk us through the specific data points that you found to be most helpful in the discussions at this meeting? You've mentioned a couple, but would you be able to walk us through what that dashboard told you as far as what you know about the job market now?
Sure. So we'll start with unemployment, which is the single most important one probably. You're at 4.2%. That's, I know that's higher than we were used to seeing numbers in the mid and even below mid threes last year. But if you look back over the sweep of the years, that's a very healthy unemployment rate. And anything in the low fours is a good labor market. So that's one thing. Participation is at high levels. It's, we're right adjusted for demographics, for aging. Participation's at pretty high levels. That's a good thing. Wages are still a bit above what will be, the wage increases are still just a bit above where they would be over the very longer term to be consistent with 2% inflation, but they're very much coming down to what that sustainable level is, so we feel good about that. Vacancies over, per unemployed is back to what is still a very strong level. It's not as high as it was. That number reached 2 to 1, 2 vacancies for every unemployed person. As measured, it's now around 1, but that's still a very good number, I would say. Quits have come back down to normal levels. I mean, I could go on and on. There are many employment indicators. What do they say? They say this is still a solid labor market. The question isn't the level. The question is that there has been change particularly over the last few months, and so what we say is as the risks, the upside risks to inflation have really come down, the downside risks to employment have increased. And because we have been patient and held our fire on cutting while inflation has come down, I think we're now in a very good position to manage the risks to both of our goals.
And what do you expect to learn between now and November that will help inform the scale of the cut at the next meeting?
More data, the usual. Don't look for anything else. We'll see another labor report. We'll see another jobs report. I think we get a second jobs report on the day of the meeting. I think. No, on the Friday before the meeting. And inflation data. We'll get all this data. We'll be watching. It's always a question of look at the incoming data and ask what are the implications of that data for the evolving outlook and the balance of risks, and then go through our process and think what's the right thing to do. Is policy where we want it to be to foster the achievement of our goals over time? So that's what it is, and that's what we'll be doing.
Hi, Chair Powell.
Okay, guys, I'm gonna close the live. I think that the highs are in or the lows are in for the dollar.
Will translate
Highs
more
in
directly
gold.
into
And
unemployment.
tomorrow we're gonna have
It's been
a different
great
picture,
ride
big
down.
reversal in
We've
all
seen a lot
the assets, stocks
tightness
as
come out
well.
of the labor market in that form without
I leave you
it
with that.
resulting in lower employment.
See you in our Discord or Twitter tomorrow.